They say if you have even the very, very slightest interest in real estate, the very, very first thing to do is to go join your local real estate investor association, because that's how you get plugged in to the community. This is the largest by far network of REIAs in Texas, with over 150,000 members going back to 2003. And REIAs provide all kinds of resources for real estate investors, things like power teams. So when you were watching those little pop-ups earlier, you might think that was a commercial. That was actually for your benefit. Those are people you need if you want to be a real estate investor. You need tools, you need money, you need an IRA that can invest in real estate, and you need contractors and power teams and all kinds of resources to be a real estate investor. And you can find those resources at the Texas REIAs. You need training, you need market data, and you need deals, and you need money. So we're going to share a lot of that with you tonight. I'm actually going to start this presentation by sharing with you a presentation on what's going on in the marketplace. So we're going to start with a market update. So here we are in the market, and what's kind of the big news when it comes to real estate? What's changed over the last couple of years? Interest rates. Interest rates changed. Okay, I like that conversation. What happened to interest rates? They went up. They went up. So they're different than they used to be a few years ago. So now they're different. So what do you think? I'm going to ask the audience for some opinions, and I'd like to get all of your opinion. And I want everybody to participate. And don't worry, your opinion cannot be wrong. Okay, so I'll give you like two choices. Like, for example, who thinks interest rates are high and who thinks interest rates are low? That's just an opinion. There's no right or wrong. So let's do a vote of the audience. Who thinks interest rates are kind of high right now? Who thinks interest rates are kind of high right now? Who thinks interest rates are kind of low right now? Okay, we got a lot of highs and a couple of lows. Okay. So my opinion is interest rates are normal. Okay, that's my opinion. I've been a real estate investor for 20 years. I've got about $30 million worth of rental properties. Many of them I've owned for 20 years. And most of them have mortgages, long-term mortgages, somewhere between 6.5% and 7.5%, which by all historical measures is normal. Now, a few years ago, interest rates got down to 3%. Okay, now that was not normal. Before that, when was the last time, before a few years ago, when was the last time before that that interest rates got under 3%? Anybody know? Never. Yeah, that would be never. It never happened before. Not in your parents' lifetime, your grandparents' lifetime, your great-great-great-great-grandparents' lifetime. It's never happened before, not even close. When do you think it's going to happen again? Never. That would be my guess, would be never. I don't know. And I'm not going to tell you, I don't have any way of predicting the future. I can't predict the future, but I would guess never, right? The number of things that would have to happen to make that happen, you know, I think you're going to be more worried about the zombie apocalypse than interest rates, you know, to get interest rates back down to that rate. But they're normal. By any historic measure, they're normal. And personally, I like normal. As a real estate investor, I really like normal. I don't like to invest when things are abnormal, okay? I'll give you an example. I do residential and I do commercial. I love them both, and I do everything. I use all the strategies. I do active, I do passive, I do buy and hold, I do fix and flip. I do them all. I love them all, and you know that makes me kind of unique from the perspective of most people that teach real estate are what we call one-trick ponies. So this is the best way. No, this is the best way. Oh, no, this is the best way. And my response to that is they're all right. You know, they all work. All of the strategies are fantastic. They have pros and cons, you know, and you use different ones are better at different times. But specifically talking about commercial, you know, a few years ago, just to give you an idea what happens when things are not normal, a few years ago, multifamily, one of the many asset classes in commercial, very competitive, hyper competitive. So people were really competing to buy apartment buildings. And because it was so competitive, they were paying top dollar, right? And they were getting them under contract with top dollar offers. And then the deal worked because they got a 3% mortgage. And at a 3% mortgage, they could collect enough rent to pay the mortgage, right, from the apartment building. But now those properties are coming due. Because commercial loans are not 30-year loans, guys. Residential loans are 30-year loans. Commercial loans tend to be like 5-year loans. Okay, they don't have to be 5 years, but it's pretty typical. They're like 5-year loans, which means they come due over and over again, right? And now all these 3% loans are coming due, right? And if you sell the same property at the same price you bought it for a few years ago, and the buyer has to get a 7% loan instead of a 3% loan, the math doesn't work. So they can't afford to buy them even at the same price the last guy bought it for. So the properties are in trouble, right? And that's what happens when you buy something abnormal, right? A few years ago, I was not very excited about multifamily because when interest rates are at a rate they've never been in the history of the humanity, there's really no direction they can go other than up, right? I mean, so everybody that's pitched me a commercial deal the last several years, I've said, what are you going to do when interest rates get to 10%? And a lot of people look at me like, that's ridiculous. Interest rates could never get to 10%. Well, actually they could, because this is an interesting chart that shows interest rates going back to 1970. And from 1970 to 1981, in 1981, interest rates got all the way up to 18%. So for everybody who thinks like 7% is high interest, quit bellyaching, guys. How about 18%? Interest rates are cheap compared to that. So yeah. Now, let's do another opinion poll. Okay, so I like it when interest rates are normal, because when interest rates are normal, like the real estate market, sometimes it's easy to buy and hard to sell. Sometimes it's easy to sell and hard to buy. It's never easy to buy and easy to sell. But I like it when it's normal, right? Easy-ish to buy and easy-ish to sell, because then you can make money, right? When things are abnormal, to me, that's kind of scary. And I'm not a gambler. I'm very risk adverse when it comes to investing. But let's do a little poll of the audience, another one. When interest rates go up, what do you think happens to home prices? Do you think they go up or down? Down. Okay, let's do a poll. Who thinks when interest rates go up, home prices go down? Okay, who thinks when interest rates go up, home prices go up? Okay, we got a bunch of downs, and I don't know if we got any ups. My opinion is they do both. Here's something interesting about interest rates. Interest rates and home prices, homes don't really care. Home prices don't care about interest rates. Home prices care about two things, supply and demand. It's all supply and demand. Only in as much as interest rates affect supply and demand does it affect real estate. Now, certainly when interest rates go up, homes are more expensive. Absolutely. Less affordable. Absolutely. Less demand. And when there's less demand, that's downward pressure on prices, for sure, for sure. But there are other forces that are offsetting those. Okay, let's talk about some of the other forces. So for example, why did the Federal Reserve raise interest rates? To battle what? Inflation. Inflation. Now, when most people talk about inflation, they always talk about it like it's this bad thing. Inflation is bad. We got to whip inflation, stop inflation, tap down that terrible inflation. Personally, I disagree. I adore inflation. I love inflation. I go to bed hoping for more inflation. I just have another name for it. You know what I call it? I call it appreciation. Because when all of your wealth is in real estate, what do you hope for more of? Inflation. Right? Because inflation means what? It means dollars become worth less, which means everything else becomes worth more. When you have inflation, where do you want your wealth? In assets, in physical stuff, things like gold, things like real estate. Anybody own a house for the last 3 years? Who's owned a house for the last 3 years? Nice, you're a lot richer than you were 3 years ago. Congratulations. What if you had 20? What if you had 200? Can't go back. Do anything you want going forward. Okay, another poll of the audience. So yeah, right, inflation makes prices go up, so that's an upward thing on prices. Another thing interesting going on in the marketplace, right, and here's the thing, right, less demand for sure, but normally when you look at the houses for sale, 2/3 of the houses for sale are resale houses and 1/3 are new construction. Right now it's inverted. Nobody's selling their house. Why is all that inventory being held off the market? Why is nobody selling their house? Mortgage rates are low. Because everybody got one of those 3% mortgages and they don't want to give it up, right? So everybody that should be selling a house and buying a bigger, nicer house is not. They're holding on to what they got. And because they're holding on to what they got, there's not enough houses for sale. In fact, I don't know if you know this or not, but we are actually living in the middle of a housing shortage. Who's heard of that? Yeah, we have 6 million fewer houses than we have people that need a place to live in a house, right? And that restriction of supply is another thing pushing prices up. So we have things pushing prices down, and we have other things pushing prices up. So there's offsetting forces. It's not as simple as just saying, oh, how interest rates are high and prices are down. That's not exactly how simple it is. And by the way, another opinion poll. Again, no right or wrong. I'd like to get everybody's participation. House prices. Let's talk about house prices. Who thinks houses are kind of expensive right now? Who thinks houses are kind of expensive right now? Who thinks houses are cheap right now? Okay. I'm not getting everybody's vote. There's no right or wrong. You can all vote. Who thinks houses are kind of expensive right now? Raise your hand if you think houses are kind of expensive. Who thinks houses are really like cheap right now? Okay. I'm going to raise my hand. Cheap. I can't believe how cheap these houses are. Oh my gosh. I was looking at the prices the other day. I'm just like tripping over myself. I mean, they're practically giving houses away. It's just ridiculous how cheap these houses are. It's really unbelievable. You know, and if you don't believe me, I'm going to convince you. And the way I'm going to convince you, don't listen to me. Don't listen to me. I want you to listen to somebody that I know that you trust. I want you to ask somebody that I know you trust more than anybody, okay? Ask them what they think of the house prices, right now here in 2024. Who do I want you to ask? I want you to ask future you, okay? So talk to yourself 20 years in the future and say, what do you think of those house prices back in 2024? You know, and what do you think future you is? You know what I'm going to tell you what future you is going to say. Oh my God, you idiot, you could have bought a house in Dallas for under $2 million. You should have bought them all. So I bought a whole pile of houses 20 years ago, mostly in 2023 and 2024. And when I was buying those houses, mostly in Austin, Texas, I paid a fortune for those houses. I was paying 110, 120. I think I spent like maybe 150 or 160,000. It was ridiculous, right? And that's how it felt. It felt like, oh my God, these houses are so expensive, but I want to buy some rental properties, so I guess I'm just going to have to bite the bullet and buy these ridiculously expensive houses, right? And I was paying 120, 140. Some of them, I might have paid 170 for some of these houses, right? In central town, right in downtown, right? You know, now those same houses today, right, are selling for $650, $800. One of them, I was just doing a make ready. I'm about to sell it for $1.2 million. $1.2 million, right? So let's try this again. Who thinks houses are expensive right now? Who thinks houses are cheap right now? Yeah, you can't go back. When's the best time to plant a tree? 20 years ago. When's the second best time to plant a tree? That would be right now. Yeah, so future you, right? Go have another chat, right? Future you is going to tell you you should have been buying rental properties back in 2024. You missed the boat. Right? You missed the boat. You missed it big time, like the deal of a lifetime, right? So put that on the to-do list, right? Let's start buying some rental properties. You know, and it's just one of many things I'm going to recommend that you do. Most of my wealth today came from buying those stupid, ridiculously overpriced houses 20 years ago, right? And if I could only go back, because I did make a mistake, I would have bought them all. I would have bought them all. I didn't buy enough. That was my biggest single mistake investing in 20 years. Real estate. I wish I had bought 3 or 4 times as many houses, and I could have. I was too picky, right? If you're going to hold something for 20 years, it doesn't even matter what you pay, right? Whether you pay a little more, a little less, it really makes no difference over 20 years, right? What matters over 20 years is just owning as much real estate as long as possible. Oh yeah, and those houses, you know, the tenants are doing something really cool. They're paying off the mortgages for me. I got 3 notices this year. Right, that 3 of the mortgages got paid off by the tenants. It's like, oh, your loan's paid off. You don't have to pay a loan anymore. It's like, oh, nice, you know. So yeah. Now, by the way, this chart here, I said interest rates went up. This red line, interestingly enough, this is actually median home prices. And guess what? When interest rates went all the way up to 18%, guess what? Home prices actually went up. Remember I said there's things pushing down, there's things pushing up. Overall, the things pushing up outweighed the things pushing down. And then when interest rates came down, what happened to home prices? They actually went up some more. When interest rates went up and down, up and down, and up and down, home prices continue to go up. Now, there's some bubbles. This is that 2009, 10, 12, bubble. Remember that big bubble? And there's some little bubbles, right? But yeah, it's not as simple as to say like interest rates cause home prices to go down. They cause demand to go down for sure, but there's other things that cause supply to go down. And when there's less demand and less supply, what happens to home prices? Somewhere in the middle, somewhere in the middle. So let me give you some data, and we'll take you through the different cities and give you an update on things that are going on. And by the way, I do want to preface all of this. Most of this data comes from the Texas A&M School of Real Estate and a bunch of online sources. We are not here to sell you something or to try to persuade you of a particular opinion. Okay, there are a lot of groups out there, and I'll name like the National Board of Realtors. They do a forecast every year. I think I've never seen them not say the market's going up. So the market's always going up. And if you ask them, they're going to tell you these are just different reasons why the market's going up. When we think the market's going up, we show you we think it's going up. When we think it's going down, we say we think it's going down. And we think it's going sideways, we tell you we think it's going sideways. And guess what? As real estate investors, you can make money in up markets, down markets, and sideways markets. But you do have to be a student of the market. And so we're going to hopefully help you become students of the market. So this is some data. We'll go through the different cities. But overall, Texas is pretty flat, up a little bit. But let's take a look at the different cities and the different roundups. So state of Texas, the average house in Texas is $425,000. Year-over-year prices up 1%. It's flat. Median price $340,000, flat. It's not up, it's not down, it's just flat. Now, what has increased is months of inventory. And I would say if you really want to just look at one number that's kind of a barometer of what's going on, look at inventory, months of inventory. What is months of inventory? One way to think of this is that if you took all the houses on the MLS that are for sale and you stopped adding any more houses for sale, how long would they last? In other words, how long before the shelves are empty? If you just didn't add any more houses for sale and you just sold what you got, how long before you're done and the last house gets sold? And it turns out it's 4.8 months, right? Which is also the average amount of time it takes to sell a house. Now, average. Some houses take longer, some houses take less, right? But if you average them all out, you got about 4.8 months of inventory. Now, let's put that into perspective. They say if there's less than 6 months of inventory, you are in a seller's market. If there is more than 6 months of inventory, you are in a buyer's market. If there's right around 6 months of inventory, you are in a neutral market. We are still in a seller's market. Now, a year ago, there was 3.5 months of inventory. So we were in a hot seller's market. We went from a hot seller's market to a cool seller's market, but don't kid yourself for a minute, it is still a seller's market, right? To put it into perspective. Now, everybody's different, right? Everybody's like, oh, the market's dead or dying or slow. Compared to a year ago, it is much slower. Compared to the average, it's a little better, right? And that's just perspective. Now, going back into some history, 2021, prices in Texas went up 18% in 1 year. 2022, they went up another 10.7% in 1 year, and then 2023, flat. So what happened with the market, it went way up, it went up some more, and then it just flattened out. And then only after the last several months are we seeing a little life, right? Not up, not down, it's a little bit up. So we'll go into some of the different cities. Starting with Houston, the average price house in Houston, $422,000, up 0.9%, basically flat. Median price, $337,000, down 0.3%, basically flat. Months of inventory, 4.5, about the same as the state. Last year is 3.2. In the last 3 years, 2021 went up 16%, 2022 up 10%, 2023 flat. And here's a little data point on leases. Lease prices are actually up a little bit. Now, when lease prices are up, what does that tell you about multifamily, commercial? Is it say they're full or they're empty? They're full. Yeah, they're relatively full. When prices are up, that means they're full, right? When prices are down, when there's a lot of vacancies, they drop prices. So even the multifamily is doing pretty well. It's not up a lot, but it's still up, right? And that's a little bit of Houston. All right, Big D. Let's talk about DFW. The average price house in DFW is $510,000. This is the second most expensive place to live in the great state of Texas, and those prices are flat. Median price $405,000, and that is also year over year flat. Months of inventory, 4 months of inventory. This is actually the strongest market in Texas. Last year it was on fire, 2.7 months of inventory. Now, I don't know why this is the case, so I'll give you an interesting data point on Dallas. Dallas, for 20 years, has always been the bellwether of Texas. I don't know why, but it's always the first to go up, the first to go down. It's always the leader. It's the first mover. I don't know why that is, but if you kind of want to get a hint about where things are going, you look at Dallas, and the other cities usually follow Dallas. I don't know why. So inventory is a leading indicator. Dallas is a leading indicator. Another thing to look at is condominiums or condominium inventory. We've always called condominiums the canary in the coal mine. Canary in the coal mine. What is it? It's the first thing to go, the last thing to come back. So when the market starts to soften, the first thing you see to go down are the condos, right? And when the market comes back, the last thing to come back is the condos. So if the condo market's hot, everything's hot, right? That's what you know. So these are all kind of little precursors to where things are going. But for whatever reason, Dallas is leading the state in terms of hotness, I guess you could say, of the market with 4 months of inventory. A little history on Dallas. Lease prices flat in Dallas. Leases are down a little bit, but the prices are flat. A little history in Dallas. Prices in 2021 went up 20% in 1 year. 2022, they went up another 15%. On fire, 2023 flat, or really up 1%, which is flat. So if you own a rental property or a house, you did really well. If you own 20 or 30 of them, you did a lot better. If you didn't own 20 or 30 of them, okay, buy 20 or 30 now so that 20 years ago we can have this conversation again. All righty. Austin. Now, Austin is an outlier, and I'll explain why. But the average price house in Austin, Texas is $573,000. That is not a typo. That is average. Okay, we did a little research trying to figure this out. Turns out Austin, where did the name come from? It turns out it is Latin for San Francisco. Yeah. Elon Musk moved to Austin, right? And Meta moved to Austin, and Apple moved to Austin, and all these, Samsung, and all these high-tech companies, and all their, high-tech engineers, and they all just moved in like in waves and waves and waves. It's like last year, California lost 500,000 people. Last year, Texas gained 500,000 people. Where'd they go? Yeah, it's like pretty obvious, and half of them came to Austin. And the market went crazy. Median price Austin, $435, down a little bit more, 4.3%. Months of inventory, 4.7, about like the state. But there's an outlier. So what was the outlier? 2021 was the outlier. In 2021 in Austin, Texas, prices went up 29% in 1 year. And I was there. So in Austin, Texas, in 2021, there was 0.4 weeks of inventory, months of inventory, 0.4 months. What is that? Less than 2 weeks. What does that mean? That means there was less than 2 weeks of total inventory in the entire city of Austin. What would happen in 2021 is somebody would put a house on the market for sale, they'd get 11 offers in a weekend, easy. 1 would win, 10 would lose. The 10 that lost would put an offer on a second house, they got 11 offers in a weekend. 1 would win, 10 would lose. And this would happen over and over again until the buyers started screaming at their realtors, "What's wrong with you? You're giving me bad advice. I keep getting outbid. What do you got to do to buy a house?" And it turns out the answer was in 2021, in that abnormal market, it became normal to buy houses at 5 to 10% above appraised value. Now, I'm going to tell you something. The bank will not allow you to buy a house above appraised value, just so you know. The total down payment and the total loan cannot exceed by $1 the appraised value of the house. So if you really want to buy a house above appraised value, you got to put your down payment down, you got to get your loan, and then you got to come up with a big pile of money to put on the top of the pile after that. And in 2021 in Austin, Texas, that was normal in that abnormal market. And houses were selling 5 to 10% above appraised value. 2022 didn't get much better because it went up another 10.4%, and then 2023 down 8%. So most of Texas went up 30% and went flat. Austin went up 40%, came down 10, and went flat. What's the difference? Well, I guess it depends on when you bought. If you bought a year ago, you lost 10%. If you bought 3 years ago, you made 30% just like everybody else, right? And that's just perspective, right? And that's why I like to put all the data into perspective. Leases are down a little bit. And then finally, San Antonio, the most affordable major city in Texas, average price $372, down 3%, median price $314, down 2%, 5.3 months of inventory. It's the slowest market in Texas. It's got a different economy than the rest of Texas. It's a less high-tech economy, a more affordable city. The history, 2021 up 16%, 2022 up 12%, 2023 flat, or really down 2%, which is flat. So that's a little bit about where we are and where we've been. Now let's talk about where we're going. So what's driving the market? Well, I'm going to give you a bunch of data points that are pushing the market up and down. First thing we have is the economy. Overall, the economy is doing not bad, right? It's not great, but it's not bad. So slightly better than not good, right? We're not in a recession technically. Real estate doesn't care about the economy, other than the fact that if people feel like the economy is bad, they're less likely to buy real estate. We also have consumer confidence, kind of the same thing. It's measured, interestingly enough, as people's opinion or confidence on a 0 to 200 scale. Anything over 100 says they're confident. Anything under 100 says they're scared. Right now, the score is 103, just over the middle, right? So they're not really scared, and that's a slightly encouraging thing. We also have unemployment. People have jobs. The unemployment rate is under 5%. Anything under 5% is considered solid unemployment, right? So Texas has solid employment. People have jobs, right? And if you have a job, you're a little more likely to buy real estate. Right? And then you got job growth. We're growing jobs big time here in Texas, right? So Texas has maybe the best economy in the country. With all that job growth, people feel pretty good and are more likely to buy real estate. Stock market. Now, again, stock market doesn't affect real estate. It doesn't directly affect real estate, but it does indirectly affect real estate. If people feel richer, like if they look at their 401ks and their 401k went up, they're like, oh, I'm richer, right? And so they're more likely to feel like they can afford to buy another house or a nicer house. And the stock market did really well last year, right? It did strong. This year it's not bad. It's kind of neutral. And then we have interest rates. Interest rates certainly pushing down, right? So there's a downward thing. When interest rates went up, things become less affordable, and that's reducing the demand. House price trajectory is flat, not really up, not really down. Closed sales trajectory is down a little, but it's actually changing. So that's something that you got to look at. Pending sales directory is flat. Active listings is flat. So all of these things are not really pushing up, not really pushing down. We are adding listings and inventory, but kind of just meeting the demand. So it's not adding a lot. Months of inventory is pretty good, right? Less than 6 months of inventory. We're in a seller's market, not a strong seller's market, but it's certainly not a buyer's market. So it's pretty good. And housing permit trajectory, are we overbuilding, underbuilding? We're just barely keeping up with the demand. So we're kind of doing pretty well there. And in-migration, now this bullet should really be a triple-size bullet, right? Not all of these things affect the market the same. Migration is really probably the biggest one on this page. Migration is the ratio of people moving in versus the people moving out, okay? In other words, it's population growth. And when the population is growing robustly, okay, then more people need a house to live in, right? Like I said, we had 500,000 new people, right, moved to Texas. So big influx of migration. And then there's another 15 million people that apparently came to the US, and a bunch of them, we don't know where they went, but a bunch of them probably went to Texas too, right? So in other words, there's a whole bunch of people here that weren't here before. And the truth is we're not building enough houses, right? And there's a reason for that. You know, back in 2002, 3, 4, 5, 6, right, we had subprime lending. Anybody could get a loan. If you wanted to get a loan in 2006, you walked into a bank, you say, I want a loan. They held a mirror under your nose. If they saw fog, you got a loan. That was the loan application, right? And then in 2008, all the banks went bankrupt. So, but we bailed them out, right? They were too big to fail. We bailed them out. And eventually they got back into the business of lending. But all these years later, today, what do you have to do to get a loan? Turn over your firstborn, fill out a 1,900-page application, submit blood samples, a lot. You have to do a lot. Money got cheap, but it never got easy. It never got easy. And 2002, 3, 4, 5, 6, 7, it was easy, right? So builders are building houses in every direction as far as you can see. And what they do with all that inventory, they gave everybody a loan, right? And then in 2008, the banks went bankrupt and lending stopped, and it crashed, right? When banks got back into the lending, eventually got cheap, but it never got easy. And consequently, we haven't been building enough houses for all the people ever since. So we're not keeping up with the demand. And when you don't keep up with the demand, especially migration, more people, because everybody that moves here has got to live somewhere, right? They got to move in with somebody or live in an apartment or live in a house. They need something, right? And if you don't build enough new stuff for all the new people, you have a major problem. So that's something that is pushing heavily in the up direction. And then we have, what else? My clicker's not working. Construction labor growth. Oh, this is interesting. We have a problem. Our contractors are dying. The average general contractor is 58 years old, and they're aging out. Okay, so if you have a teenager, don't send them to college. Give them a hammer. Okay, seriously. Make them a contractors. You know, contractors make more than PhDs now. You know that, right? Right? They could be a contractor. They don't have to work for a jerk. They'll make a lot more money. They work for themselves and get no student debt. I mean, this is like serious. I was reading this article about this surgeon. His toilet broke, and he had to hire a plumber to fix his toilet. The plumber fixes the toilet, like gives him a bill. And the surgeon's looking at the bill like, oh my God, this is the kind of a price that a surgeon might charge. And the guy's like, yeah, I used to be a surgeon. You know. Yeah. Give your kids tools, right? I mean, make them contractors. And I used to be able to build houses for like 150, 160, 180, and then it was like 200 a foot, and then it was like 220 a foot, 250 a foot. Some of these houses are costing like $300 a foot. It costs a fortune, right, to build anymore. And all of that is making building harder, building more expensive, and that's why we don't have enough houses. So we got a problem there. And then, you know, there's some wild cards. I hear there's an election going on. I got a couple of wars running around, right? And then the question is interest rates. What's going to happen next? Well, the answer we got last week, right? Interest rates came down a lot, actually 0.5%, which is more than we expect. And the Federal Reserve is forecasting they're probably going to drop it. So earlier this year, you know, like at the very beginning of the year, we're like, interest rates are going to drop later in the year. And then in the middle of the year, we're like, I don't know if they're going to drop interest rates or not. And then surprise, big drop with a forecast to drop it more. So we expect now we're probably going to get a pretty healthy drop in interest rates. So those are all the drivers, up and down and sideways. Let's do a poll of the audience. I don't have an opinion on this. I just want to ask your opinion. Who thinks prices are probably going to go up from here? Who thinks prices are probably going to go up? Who thinks prices are probably going to go down? Okay, got a lot of ups and a few downs. I would say there's nothing I can see that would likely make prices go down. I mean, like a major war, something really unexpected, maybe, I don't know. We never know for sure. But there's a lot of things pointing in the direction of up, and there's not much pointing in the direction of down. But the truth is there's not much pointing in any direction at all. So I'll give you our forecast. Our forecast is that that was probably the bottom of the market. I hope you enjoyed it. There wasn't much to look at. A few months back, maybe 4 months ago, we started to get a very slightly upturn. And with interest rates dropping, this was actually updated 2 weeks ago, so I need to update this. Probably by a 1% or more by the end of the year. We expect prices to be up a little bit, maybe 3%. So we don't expect a lot. You don't expect prices to go up a lot. We don't expect prices to go down a lot. We expect sales to pick up a little bit and prices to go up a little bit. And that is our forecast. And by the way, I don't do the forecast. I just am reporting the forecast. We've been doing forecasts, though, for 20 years. And I will tell you, just to be prideful, this organization has always been pretty spot on with the forecast. And I'm not saying it's because we're like geniuses or something. Not at all. I'm going to say because it's not that hard to do, right? Trying to predict the economy, very difficult. Trying to predict the stock market, impossible. Trying to predict real estate, not that hard. And the reason is because we know almost everything about it. We know how many houses we have. We know how many houses we're building. We know how many people live here. We know how many houses we're building. We know how many houses we're going to need. We know how many we're going to have. We know everything. We know how many we need. We know how many we have. We know how many we got. We know how many we're going to have, right? We know everything. The only thing we don't know is exactly what the interest rates are going to be and a couple of little variables. But the major things that affect supply and demand, we know. And based on all that stuff, there's not a whole lot to look at in terms of expecting by forecast the market to dramatically go up or down. It's probably going to kind of keep about where it is and then tick up a little bit. So did you guys enjoy that? Was that helpful? Yeah. All right. Yeah. All of our data is published on our social media. I'll give you some links to that later. You can update it every month. If you want to pull down these slides, you're more than welcome to pull them down on our social media.